Today, Bitcoin and Ether end the week in the red following the release of crucial inflation data. And Max Gokhman with Franklin Templeton Investment Solutions breaks down what's driving crypto prices right now. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Crypto prices are in the red to end the week, with Bitcoin dropping to $109,000 as of noon Eastern. Now, Ether fell about 1.5% to just under $4,000, and Solana's Sol token dipped more than 2.5% to under $196. The moves lower come after the release of crucial inflation data. Last month's Personal Consumption Expenditures Price Index, the Fed's preferred inflation measure, showed that core inflation, which excludes food and energy costs, ran at a 2.9% seasonally adjusted annual rate. That number was in line with expectations from economists polled by Dow Jones. Now, this inflation data came on the heels of solid jobs data released yesterday. Investors fear that fewer jobless claims could mean that the economy is in decent shape and would therefore give the Fed less of a reason to cut rates. Now, for the week, Bitcoin is down more than 5% as of noon, on pace for back-to-back weekly losses. Ether is down more than 11% week to date, on track for consecutive weekly losses, and its fourth negative week in the past 5. Ether is also pacing for its worst week since April 18th, when it fell more than 13%. Meanwhile, Sol is down more than 16.5%, on pace for back-to-back weekly losses. A rough week for the cryptocurrency market. All right, jumping right to our main story as we focus on today's crypto sell-off. I spoke with Max Gokhman, Deputy Chief Investment Officer for Franklin Templeton Investment Solutions, on what's behind the moves lower. He also provides his outlook for prices for the rest of the year. So we're seeing Bitcoin dip below that $110,000 level today. Other cryptocurrencies like Solana's Sol token are also in the red. What do you think is driving the sell-off?
I think part of it is we're seeing some trouble in the DATs, the digital asset treasuries. And I think part of that is there was this view that they were somehow going to trade at a premium to their net asset value. If you think about it, they really are just a vehicle for getting access to those tokens, sometimes with leverage, which does carry additional risk, of course. But ultimately, it is still a pass-through. And I think bringing them closer to NAVs actually makes a lot of sense. And some of that euphoria going out, I think, is partially what's going on. We also have seen some other liquidations across Bitcoin, especially. And I think that's just part of normal market behavior, especially for an asset class with this much volatility.
I do think that DAT trade has been really interesting. You saw that run up in the summer, and then a lot of those names begin to sell off in August. Do you think of them in different camps? So you've got BitMine Immersion, that's Tom Lee's vehicle, but then you also have an OG-like strategy. Are there winners and losers within the DAT trade?
I think it's going to get fairly commoditized. And, it's almost like whenever we have something new, I think about something totally different, the AI trade, right? We used to really talk about foundational models from Gemini and Llama from Meta and Claude. And the reality is they're all a little different. But, when we use AI tools internally at Franklin, we generally find them fairly interchangeable. DATs are even more simplistic, where some will use different ways of accessing leverage. Some will have marginally better parameters that are obviously going to be, treasuries of different tokens and different token portfolios. But broadly speaking, it should be a fairly commoditized play. And I think part of that washing out and normalization is actually really healthy for the space.
What's your outlook for crypto prices as we head into October and enter this last quarter of the year? Do you think that we can see prices bounce back, potentially surpass those recent new all-time highs for cryptocurrencies like Bitcoin and Ether?
Yeah, I would say my outlook is generally bullish, and it's bullish for risk assets in general, including equities. But I think with digital assets, we should see more coordination between the SEC and CFTC. That should be really positive. We should see greater regulatory clarity, especially on multi-token portfolios and ETFs coming out. That's going to be a tremendous positive impact as well. We've already seen just how much demand there is in TradFi to get access to digital assets through traditional rails. And I think broadly, as we have monetary easing from the Fed and pair that with kind of a beginning of a secular de-dollarization trend, all of that is going to send at least the marginal dollar into blockchain-enabled assets. And I think that's really good for the crypto segment.
And to your point about macro data being such a big part of the narrative when we talk about the cryptocurrency market, this morning we got the release of crucial inflation data, and markets continue to price in 2 quarter-point rate cuts at the Fed's upcoming meetings, according to the CME FedWatch tool, which is what the central bank has projected. How could those macro factors, including those potential rate cuts on the horizon, impact crypto prices, and how soon would that be baked into what we're seeing in the market moves?
I think you're going to see it baked in, really already in terms of the 2 cuts. We're seeing that in equities and the reaction that they've had post the Fed move, which was kind of nothing actually, right? And I think part of that is we were expecting a cut in September. We got it. We got a pretty data-dependent commentary from Chair Powell. I think where things are going to get more interesting is as we get closer to the replacement of Powell. And for example, we saw, the new Fed Governor Moran talking about how maybe tariffs are not inflationary. And obviously, we all think he was the dissenter, pushing for a 50 basis point cut at the last meeting. So whoever else comes in from the administration onto the Fed board, and certainly the chair, we would expect they're going to drive a much easier monetary policy, kind of inflation be damned. And as the market starts pricing that in, really across equities, fixed income, and crypto, I think we're going to start seeing those effects. And I would expect closer to March of 2026 is when that really starts getting priced in.
You mentioned that regulatory clarity was another key catalyst here. All eyes are on Capitol Hill as lawmakers, including Wyoming Senator Cynthia Lummis, expect that we could have a market structure bill become law here in the U.S. by the end of the year. How would that affect crypto prices?
I think it'll further support them. I think everything that moves us towards regulatory clarity is going to be really supportive of.
And can I ask you, is that because suddenly you have this influx of money from TradFi because they're finally going to feel comfortable with lawmakers giving them hard and fast rules on the space? Or is it just existing buyers being more bullish, really piling into the trade? I'm just trying to parse what exactly changes.
So great question. And I think it's going to be one and then the other. So we're already seeing a greater institutionalization of digital assets. For example, the average transaction price for Bitcoin across most major exchanges is north of 100,000 USD. So that to me says these aren't retail investors making small trades, but it's still not, investors like us and our peers making, trades in the millions of dollars. So the centralization of key digital asset markets and key crypto markets is really important to drive further adoption. Interestingly, it may also suppress volatility within the space, which will create the snowball effect of even more institutions coming in. I think one thing that was really telling is there was a story about potentially Vanguard, which was really not at the vanguard of pushing towards digital asset adoption, now saying, okay, we're not going to launch our own ETF products, but we're going to let some third parties onto the platform. I think what we're seeing with all this regulatory clarity is financial intermediaries starting to look at the space and, quite frankly, not patronizing their clients anymore and saying, okay, we're going to actually let you participate in this. Then they come to folks like us and say, okay, how do we create models that integrate digital assets and traditional assets? And then, institutional players are starting to have conversations with us on saying, we're actually want to get a bit deeper. We want to look beyond just passive exposure. What can you do on the active front? How can we think about, these projects beyond crypto, but really in DeFi, in, apps and smart contract platforms? And all of that is only possible if all of the players know how they can be taxed on these assets, how they can trade and clear them. And so that's why the market structure regulation is so important.
Last question for you, real quick. What does this change for Franklin Templeton? Because you have already been so progressive in your thinking about the crypto industry well before you had an administration who was favorable to digital assets.
It just pours fuel on the fire for us. We have been expecting that there would be greater adoption of the space. We've been building a lot of technology behind the scenes. And what this means is now, much more than before, us, really needing to go to clients and say, hey, let us talk to you about digital assets, feeling a little bit like door-to-door preachers. We're actually seeing the clients come to us and they want to hear the sermon and they're excited and they look to us as leaders in the space. So it's been a really, really great momentum from that perspective.
Okay, that's all for Crypto World this week. We will be back again on Monday, and we'll see you then.